To round out this discussion of central banking, I think it's worth noting that over the last 100 years, we've seen the emergence of numerous international institutions, which are beginning to replicate some of the aspects of central banking, but on a global stage. While none of these institutions is necessarily a truly global central bank, they do perform some of the functions that a global central bank might otherwise play. So I want to briefly explore three different institutions over this next segment. The Bank for International Settlements, which ensures payments between central banks and helps to coordinate international standards. The International Monetary Fund, that provides lender of last resort facilities for states. And the CLS Group, the Continuous Linked Settlement Group based in the United States, that helps to net out global Forex transactions. So let's begin with the first of these, the Bank for International Settlements. The BIS was established in 1930 as effectively a bank for central banks. It was originally designed to help facilitate flow of money into and out of Western Europe and the United States to aid in what was called the Young Plan, to try to facilitate the flow of war reparations between the various combatants from World War I. Now, until 1960s, it was largely focused on simply moving money between Western Europe and the United States. But today, the BIS has expanded its mandate. It now has a total of 63 members that comprise roughly 95% of the economic activity of the entire planet. So in this sense, it is much more of a global central bank or a global clearer of payments for central banks than it was when it was originally founded to try to move reconstruction money and reparation payments between various national governments. Now, the BIS has used either gold for its currencies for intergovernment transfers, or since 2003, it has used the International Monetary Fund's special drawing rights. But traditionally, payments between governments were settled in gold by moving around claims on central bank gold that was coordinated by the BIS. Now, in addition to facilitating these kinds of payments between governments and between central banks, the BIS also is home to a number of economic research departments who provide a great deal of insight for central bankers on the efficacy of different kinds of monetary policies and on how to create superior payment systems. One of the things that the BIS is particularly responsible for was the creation of the Basel Capital Accords starting in 1988. The notion to create these sort of global standard for risk in banking started in 1974. There were two significant international banking failures, both Franklin National in the US and Bankhaus Herstatt in Germany, which ultimately exposed the thinness of monitoring international risk exposures. Most regulators at the time tended to focus on domestic risk exposures because most banks tended to do their business domestically. But what had escaped the regulatory net was international lending. And this is where problems started to build up in the unregulated space. And after their collapse in 1974, there was a significant move by central banks to try to find ways to quantify these risks to prevent the kinds of problems that had emerged in the 70s. Furthermore, another push to try to create these international standards happened in 1980s. In the early 1980s, there was a significant problem with the national debts of a variety of Latin American countries. In particular, what happened is their governments found that they were unable to maintain payments on their national debts. This led to significant economic crisis throughout South America. And interestingly, it highlighted the dangers of undercapitalized banks, which we tended to see all over South America, who had portfolios highly concentrated in supporting their states, who had suddenly failed to meet their obligations to borrowers. And as a result, there was, again, a need to establish some kinds of international standards so that international lenders would have some idea about the relative risks that they were exposed to. And thus were born the Basel Capital Accords. A decade after the introduction of the Basel Accords, the BIS created what was called the Financial Stability Forum, which later became the Financial Stability Board, which was ultimately designed to manage and promote cooperation regarding global systematic risks and to help make recommendations to members, central banks, about how they ought to try to mitigate the domestic aspects of these sorts of problems. Today, the Financial Stability Board is the organization that assesses whether or not a financial institution is what they call a GSIB, or a globally significant financial, a globally systematically important bank. GSIBs, in that sense, are required to carry more capital because there is a recognition that a failure of one of these large global institutions is likely to cascade into failures of smaller institutions as well. And so, given that these are globally systematic institutions, the BIS, through the Financial Stability Board, has been trying to promote the notion that they need to be safer than any given domestic bank, given the magnitude of a crisis that a failure of one of these organizations would create. Next, we have the International Monetary Fund. The IMF was created in 1944 as part of a suite of new organizations that would help to manage the sort of new world order that emerged in the aftermath of World War II. The principle was very straightforward. It was understood that countries that fell into financial crises did not keep their problems at home, and that it was very difficult, in fact, to keep a economic crisis from developing into a political crisis, which again was at home. Part of the impetus of this was recognizing how the economic crisis in Germany in the 1920s had helped to set the stage for extremist governments in the 1930s that prompted a global conflict in the 1940s. And as a result, it was understood that simply letting countries fail was actually not in anyone's best interest. It's sort of like all of us being on the same bus and not worried about one person who's becoming very ill. It's entirely likely that one person who's ill on the bus is going to infect the rest of us, and we should be concerned about their health. In that same sense, we should pay attention to the possibility of failed states, and if there is an opportunity for us to intervene to provide this sort of emergency liquidity to a country, it is generally accepted that we should try to do this to prevent state collapse, which of course can bleed across borders and create armed conflict between countries. Now, interestingly, the first country to seek the IMF's help was France, who received a loan in 1947. Since that time, we've seen the IMF has largely been focused on developing countries, as opposed to necessarily focused on rebuilding shattered nations from World War II. They've tried to become a little bit more focused on what we would otherwise call peripheral countries to the world economy, in order to try to create a sense of stability, which might otherwise not exist if these countries were to simply manage their affairs on their own. Today, the fund for the IMF has enormous amounts of capital available. There's roughly $800 billion available, with an additional $450 billion pledged by the various member states. But the IMF effectively is a way for countries to pool their excess capital to make loans to one another. So this is not like necessarily a central bank in the sense that it provides loans to commercial banks, but instead it is the same sort of pooling that we see of a central bank, whereby a banking network can move liquidity to where it's needed in order to maintain stability. And in the same way, a collection of countries can get together, form the IMF, and move money around internationally to various nations in order to help restore economic equilibriums. Now, the loans from the IMF do not come without strings attached. In general, IMF requires not collateral from its borrowers, but rather that the borrowers undertake economic reforms. In general, this is what's referred to as the Washington Consensus. And even though these are effectively macroeconomic textbook solutions to solving problems, they've been heavily criticized because the IMF throughout the 60s, 70s, and 80s did extend a number of loans to countries that were in difficult situations, and the conditionalities associated with these loans may actually have made their financial situations worse. So the IMF has been working quite a bit to reform the Washington Consensus and try to change up a little bit about what sort of policies they expect different countries to pursue. Because as we saw in the most recent round of the European crisis, imposing austerity on countries like Spain or Portugal or Greece, in fact, made the situation much worse than it necessarily needed to be. IMF loans were designed to try to maintain the aggregate consumption in an economy, not to necessarily strangle it through enforced austerity. But nonetheless, the traditional Washington Consensus, in many cases, is focused on trying to reduce the impact that kleptocratic governments might have on the functioning of the state. And you can see what seem like a very reasonable list of conditionalities that are typically applied. austerity to try to reduce deficits, privatization to raise funds and replace government of control of inefficiently managed state-owned enterprises, a reduction of subsidies, price controls, corruption, all of which can distort the efficient allocation of resources, improved shareholder rights to try to encourage people to make long-term investments, whether these are domestic or foreign investors, a devaluation of the currency in order to improve competitiveness and get more people back to work, and a focus on exports and resource extraction in order to bring fresh capital into the country, which could be used to try to build a bridge to economic prosperity. But once again, the big problem here is that we assume that every country that runs into a difficult situation ended up in this situation for the same reasons, which was corrupt government failing to manage the situation. This is not always the case. And we've actually found that these sorts of conditionalities imposed by the IMF can make matters worse. And thus the IMF is undergoing a process of reform in terms of what the best macroeconomic policies it should encourage in its borrowers are. Interestingly enough, the IMF has its own unit of account that it uses for these kinds of intergovernment payments. It's actually the currency, a current currency of Bank of International Settlements, what's called the special drawing right. The special drawing right from the IMF is designed entirely for intergovernment loans to one another. It used to be pegged to gold, but since 1973, it has instead been backed by a basket of major currencies from the participants in the International Monetary Fund. New SDRs can be created at any time. What that effectively does is it expands the base of money that governments are willing to lend to one another, effectively by putting more money into the collective pool that they can draw from in the event that there is a crisis in some particular country. But SDRs are almost see no usage outside of the IMF and the Bank for International Settlements. Even though there has been some discussion that this is a true global currency, the fact is that the special drawing right is in fact just a representative currency that is underlaid by all this basket of global currencies, which means it doesn't really have its own independent monetary policy. It's not necessarily lent out at a competitive interest rate. And of course, it is subject to the credit worthiness of all of the contributors whose assets underlay the value of the special drawing rights. Finally, I want to talk really quickly about CLS Group, with the Continuous Linked Settlement organization that was originally spun out of the New York Fed back in 2002. The CLS Group is designed to create a clearinghouse for foreign exchange payments. And this is a dramatic improvement over the way that a lot of foreign exchange payments were made throughout the 20th century. Traditionally, Forex payments were settled through what were called correspondent accounts, which involved a bank having deposits in a number of other banks around the world so that they could settle their interbank transfers in this way. This meant, of course, that organizations like JP Morgan had deposits in literally dozens of institutions around the world simply to be able to clear foreign exchange payments. Now, this type of bilateral clearing is often fairly inefficient, and there's been a significant push, particularly in the 21st century, to move towards multilateral net settlements as opposed to bilateral net settlements between institutions. And this has dramatically reduced the amount of money that needs to move around in these systems and dramatically simplified estimating the risk exposures that are embedded in these kinds of clearing transactions. And as a result, we've seen a significant move towards clearinghouses and away from this old system of correspondent accounts. Now, to give you an idea about the scale of CLS Group, over 50% of all foreign exchange transactions for 18 different currencies flow through the CLS. It is the single largest clearinghouse for international Forex transactions between commercial entities. Interestingly enough, it was also originally created within the US Fed in response to the Herstatt or the Bankhaus Herstatt collapse in the 70s, but they ultimately felt that it was important to spin off as a separate organization from the US Fed to enable it to pursue other business avenues outside of simply trying to help clear payments to and from the United States itself. Interestingly enough, since 2008, CLS Group has also begun to help with the clearing of over-the-counter credit derivatives for the Depository Trust and Clearing Corporation, which we'll talk about a little bit later in the course once we start talking about markets. The DTCC processes nearly all US securities trades, as well as a vast quantity of international ones. So again, we see these kinds of clearinghouses functioning like a central bank does to facilitate the flow of capital between various organizations.